Okay, so now I'm going to talk about how to play earnings, which is actually a fool's game. So every 4 quarters, market-listed companies are required by the SEC to host an earnings call and detail the company's financial performance, health, and possibly their future outlook. Most people who start trading end up learning the hard way about how to trade a stock through its earnings report. Simply put, just don't do it. When a stock announces its earnings report, this causes some of the most unstable and unpredictable short-term price action through the stock's yearly cycle. Most stocks have several analysts covering the stock that give estimates of what they think the company will report for earnings. Then once the company announces the official earnings report, the stock reacts typically very heavily, either up or down, depending on whether they exceeded the estimates, met the estimates, or reported lower than the analyst estimates. The problem is that stocks can react completely differently under all circumstances. I've seen stocks beat the analyst estimates and the stock skyrockets. Yet I've also seen stocks beat the analyst estimates and the stock ends up plummeting. Although typically with earnings plays, if the stock beats the analyst estimates, then the stock will rise. If it reports less than the analyst estimates, then the stock will typically fall. If it meets the estimates, then it'll just be more neutral and stable, and it's kind of more hard to predict of where it's going to go. It's a huge gamble of trying to predict how a stock will react to its earnings report. In most cases, I feel stocks more often react negatively on their earnings than positive. So I definitely don't recommend holding a stock through its earnings report, period. It's just not worth the risk. In just about all cases, a stock's earnings report is released in after-hours trading, which will cause huge upside or downside gaps leading into the following session. So if you're not there to react to the news during non-market hours, you can get screwed over big time. The liquidity of after-hours trading is also very thin, so a stock will move very fast and in large percentages, which can either make you win or lose very big. I've made the mistake several times over the years of holding a stock through its earnings report, and I really have regretted it just about every single time as I've tried to play earnings, hoping to catch a large gap up on a strong earnings report, yet I've actually just lost big several times trying to play earnings. There is no way to predict how a stock will react to its earnings report. It's likely to move significantly in either direction, and it's better to be safe than sorry and just sit on the sidelines than trying to make the gamble of predicting where the stock's going to go. Yet there is a way to play earnings reports, just not in real time as they happen. If a stock reacts positively to earnings, then usually an initial spike in volume and price occurs. This can often be the first run of a three-phase breakout pattern. So instead of trying to gamble through the earnings call and hope for the best, you can play off the positive earnings sentiment and chart pattern that is created based off the earnings report in the coming weeks to months. In addition, if a stock starts moving during regular market hours after reporting strong earnings and it breaks out of one of the FOOS4 patterns, this can also be a potential great time to buy in on the good news plus the bullish stock chart pattern. Earnings season in general is also something to be very cautious about, as this is a very turbulent time in the stock market. It's when everyone is nervous and on their toes because they are anxiously awaiting to hear about how the company performed over the last quarter. As the major companies in each sector report earnings, this weighs heavily on the stock market. So even if the stocks that you are holding are not reporting earnings, major companies that report positive or negative results will have strong reactions that can and will affect the entire market and their sectors as a whole. Earnings season is the easiest time of the year to lose money. The market becomes unstable and creates erratic trading that shows up with heavy swings up and down, so it is easy to get stopped out of positions or take quick losses when the market turns on you. So it is often wiser to lighten up on your portfolio and remain conservative and cautious while trading through earnings season. Earnings season occurs the month after each quarter of the year, so in January, April, July, and October. So it's important that you stay aware of these months and double check when your stock's earnings date is so you don't accidentally get screwed by a bad earnings report and you have the chance to sell before the actual earnings announcement. So actually, we're going to take a couple minutes to look at some examples of what can happen when you're holding a stock through a bad earnings report and how much money you can lose based off just the reactions that they get once the stock reports below analyst estimates and the kind of the drop effect that can happen. So looking here, this is Avery Dennison. I don't even know what this company is, but this was an earnings report. So say somebody's holding this stock through here, hoping that this earnings report's going to be good, and the stock goes up. Yet, as the company reports earnings during non-market hours, in after-hours trading, the stock dropped from $38 down to about the mid 35 area, and then opened down here, and then just completely plummeted throughout the rest of the session down to 32. So people that were holding this stock before the earnings report got completely screwed by this huge gap down, plus another huge drop during the session. Same thing here. People holding this stock, hoping for the best, that this company is going to report strong earnings, they get completely screwed by holding through the earnings report, and the stock plummets. Here's another example. So as you can see, anytime a stock reports earnings and the news is bad, there's usually a very large gap down and a very negative reaction, and a lot of people end up selling, which can lead to you selling or losing a lot of money on the stock. I was actually long this stock, Joe's Jeans. I bought into this mini force pattern breakout on this breakout here, bought in, and I sold it up here as I knew earnings was coming out in a day or two. So I sold the stock before earnings because for a small profit, because you never know what's going to happen on earnings. If it reported strong earnings, it may have blown up, but it didn't report very strong earnings, so it gapped down all the way back down to where I bought it. So I would have lost all my profits if I would have held this stock through earnings. Here's another NASDAQ bulletin board stock. So this is stock is trading on the OTCBB, which is the over-the-counter bulletin board exchange. Thing to take note about these stocks is that they're not typically required by the SEC to report their earnings, or they're not allowed. They don't have to forewarn you. Usually, when you're holding a stock, they will forewarn you, saying this is when we're reporting earnings. Stocks trading on the OTCBB don't. I was actually long this stock on this survival pattern breakout, as it was looking very strong here, breaking out on volume. And the earnings report came out after hours, and I wasn't expecting it. I didn't know that the earnings report was coming out, because these companies are not required to tell you that they are about to release earnings. It was a bad news report. I ended up selling for a pretty significant loss because I was holding this stock through earnings, although it was on accident. So you have to be cautious with OTC BB stocks, because they are not required to forewarn when they are going to be announcing earnings. Here in an example, this was actually ZEP reporting positive results. So you can see here this stock blew up when it reported positive results. But then the next quarter, right here, this was also its earnings report. They reported this day, and this stock just absolutely plummeted down and got hammered. So there's a 50-50 chance of you getting screwed, or you might make some money, and it's just absolutely not worth the risk. The risk-reward ratio is just not there at all. So I highly recommend not trading a stock through its earnings report. So as I said before, there is a way to play earnings. As you can see here, this is Eastman Kodak. This was its earnings report. The stock was rallying. It reported bad earnings, and the stock just absolutely plummeted after reporting earnings. Then the next quarter, it reported earnings again here, and the stock plummeted. Here was its next earnings report. It reported positive earnings finally, showing signs of a possible rebound after the stock had been selling off. So as I said before, that first initial push in a positive earnings result could be the first phase of a phase 3 breakout triangle formation, and that's exactly what happened here with EK. It got a big rise in volume plus the rise in price, followed by the consolidation in phase 2, followed by the phase 3 breakout, and this was actually a Foos revival pattern here as well. And this was huge volume on this breakout. So this is a pattern that you could buy into, and this all was sparked by a positive earnings report. So as I said, you don't want to play the earnings in real time. There's not really any point of buying into this day of earnings, because it's not really a very good pattern. What it was the first phase of a phase 3, a 3-phase breakout formation, where it had the price in spike in price plus volume consolidation in phase 2, followed by the breakout. So that's typically the way you want to play earnings. Play off the positive sentiment that positive earnings report creates. Don't try to predict how a stock is going to report earnings and hope for the best, because you can see here This was trying to predict earnings. If you wanted to be long this stock, you would have got screwed. You would have got screwed again here too. So here, if you would have bought in before, sure, you would have made some money. But as you can see in the past, it's not a very smart decision to be trying to predict how a company is going to react to its earnings report. Okay, so now I'm going to go over a little bit about getting started in the stock market. So when you first are getting started, you obviously need to have some kind of trading capital to begin with. I get asked all the time about how much money do I need to get started in the market. Well, hell, you can open up some online accounts with brokers with just $500 or less. But, good luck trying to do anything with a $500 account. For one, you're not going to be able to diversify, and if you did diversify $500, the cost of commissions plus the small gains you would be taking would take you nowhere fast, and it would be extremely hard to build your portfolio. My recommendation for the minimum account size to get started the right way in the market would be around $10,000. This is a solid amount where you could diversify properly as well as reap enough profits from your position size to substantially increase the value of your portfolio over time by using this strategy. Now, obviously, a lot of people, don't have an extra $10,000 lying around to invest in their trading career. So you can start with whatever amount you have. My recommendation, though, is $10,000 just to have a solid foundation to start with. The next question you should be asking me once you've got some capital is how much money should I put into each stock? This is because diversifying your portfolio is key to survival as an active trader. You can't just throw your whole bag of chips in one stock and hope for the best. You need to set a certain amount of capital that you are willing to put towards each position to avoid the risks involved with having all your eggs in one basket. Back in 2005, I remember my family got a stock tip for a speculative biotech stock called Cytomedics. The ticker was GTF. And a great uncle of ours had recently passed and left my mom's side of the family with a nice little inheritance check. So they all decided that putting a large sum of their inheritance into just one stock would be a good idea because of the potential return. But of course, they did not consider the risks, and none of us had any experience in the stock market at the time. So everyone bought into this stock, GTF, in the $3 to $4 range. Take note that this was also my first trade that I ever made, and it was my entry into the stock market. Even my girlfriend bought in at the time, with the measly cup at $100 because everyone was so pumped about this stock tip that we'd received. So the stock continues to climb and climb upwards near $6 per share, and I decided to sell because all of my money was in this stock. I was bored and took my profits, yet I didn't even tell anyone in my family because, they would all give me crap because they think this thing is going to be going up forever. I didn't even tell my girlfriend. I wanted to be a trader. This buy and hold crap was just no fun, and it wasn't for me. So the stock then climbed up near about $7 per share, and everyone was extremely excited as this stock just hit new highs. But then a few weeks later, just about the worst thing possible happens. Cytomedics went bust on a bad news release about its drug trials, and the stock wiped out all of their gains in just one day, as well as plenty more as they had also been buying on more shares on the way up. So around $100,000 was lost in just a single day because they were all betting the farm on one stock. As you can see here, on this stock chart, we're getting this stock tip for some drug or something they were doing. I don't even remember. But everybody bought into this stock. We didn't diversify in anything else. This was just the only stock we knew. We got a stock tip about it, and we weren't diversified in anything. So everybody's money was wrapped up in this stock. And then this news report came out with a bad press release about their drug. And look at this single day decline. Everybody's money was lost. They lost all their money and then some. So this is a perfect example of how diversification or not diversifying can completely screw you over, and stuff like this happens all the time. And I was just lucky enough that I actually got out before this all happened. It had nothing to do with me, necessarily being smarter than them. We are all blinded by greed and in the fantasy of this stock, skyrocketing, and we had all our money wrapped up into this one position, which is a very bad idea. Just the lack of knowledge about how to diversify and the risks involved in the stock market completely wiped them out. Even that was back in 2005. It's now 2011, January 10th, currently right now, and some of them are still holding this stock. And it's down at about 50 cents now, because they're bag holders. They're holding on to the stock, hoping that someday it comes back up. Uh, it's just not a wise decision. That's exactly why I was saying you also need to cut your losses short. You can't become a bag holder. As with this case with GTF, there was that huge gap down where you didn't even get a chance to sell out of the stock. But that's exactly why you must diversify, and you can only have a small amount of your capital into each position so that you're not completely wiped out if one stock goes bust in your account. And so the reason why I suggest starting out with $10,000 is because this gives you the ability to set up diversification rules in your account so that you're not significantly hurt by one stock tumbling in your portfolio. I personally recommend investing a maximum of 10% of your total capital into any given stock at one time. So with $10,000, this would give you $1,000 per trade to profit on with your $10,000 account. Now, many times you're going to be tempted to place more money into the stocks that you think may be the big winners rather than just 10%. I'm also urged to do this from time to time. But too many times in the past have I kicked myself for once again throwing too much money into one stock, and I lost a lot more than I should have because it became a losing trade and I was just being a greedy idiot. Just take this game slow. It's not a race. If you make any profit in the stock market, you're in the top 10% of the trading world, as only 10% of the traders out there ever do it consistently and survive the game. One reason why so many people lose in the market is because they bet bigger than they should. And yes, sometimes people do cash in big for betting big. The problem is that once you start doing this, it can become a really bad habit. So every time you're betting big, it may just be your last trade if it goes extremely sour, and you might just wipe yourself out of a huge loss in your account. So the bigger the bet, the bigger potential loss, and vice versa. But the goal as a trader is survival and steady gains, not making crazy ass gambles hoping that you come out on top. So up next, we're going to talk about something pretty important, and that's balancing your risk reward. Now, you can't just throw your money at any stock and expect to win. You have to find stocks with attractive risk-reward ratios, such as stocks that have FOOS patterns that I'm detailing in this DVD. For any stock that I enter, the potential reward that I see in the trade has to be double that of the risk I'm willing to expose myself to. My standard as a small cap trader in stocks mainly under $10 per share is that I'm shooting for a 20% gain or higher, while risking just half that of around 5 to 10% maximum loss or less. So given a 10% or a $10,000 portfolio, I would invest $10,000 into a stock, $1,000. So this would mean that for this trade, I'm shooting for a $200 gain or more while risking just half that or less of $50 to $100 maximum loss. Hopefully less, if you can get out earlier. With this kind of risk-reward ratio, you can have about a 70% losing strategy and still be able to break even if your averages come out with an average winning trade of equal to 20% gain and an average losing trade equal to a 7.5% loss. The ideal goal is that you can trade to win 50% of the time or more. So let's set up an example with 100 trades using $1,000 per trade and a 50% winning ratio, and then deduct commission costs and see where we come out. So 50 trades at an average loss equal to 7.5%, is equal to $3,750 in losses, and 50 trades at an average 20% gain is equal to $10,000 in profits. So your total profits on your trades is $6,250. That's $10,000 in winnings minus your $3,750 in losses. And if we factor in commission costs at roughly $650 per trade at a total 200 round-trip trades, then we come up with a total profit of $4,950 or a 49.5% return on your portfolio. Now, if you start getting the hang of things, it's possible you become a lot better at picking stocks and bumping your winning percentage up just 10% to around 60% winning ratio, and this can really make a big difference. So let's take a look at our model with a 60% winning ratio. So we got 40 trades at an average loss of 7.5% is equal to $3,000 in losses, and 60 trades at an average 20% gain is equal to $12,000 in profits. So the total gain from trades is about $9,000. Then if we factor in the commission costs at roughly $650 per trade times 200 total round-trip trades, then we're coming up with a total profit of $7,700, or a 77% return on your portfolio. Now, note that having a 60% winning strategy is a pretty damn tough thing to do. To be quite honest, it's very possible that you will never have this much success in the stock market. Trading is far from easy, and it's extremely difficult to win consistently. But anything's possible, and some people really do have the knack for this. It just needs to be remembered that stock trading is a tough game, and if it was easy, then everyone would be out there making a lot of money. Okay, so now next we're going to be talking about portfolio management. A lot of people have their trading accounts, but they really have no idea how to manage their money correctly and do it in a safe way that maximizes profit potential as well as lowers your risk. So I'm going to go over some strategies to use for portfolio management. So again, first of all, I only invest about 10% maximum capital into any given position. And there's certain ways of only investing 10% into any position. I usually only like to open up a trade with that maximum 10% if I can catch a stock, at or around right as it's breaking out. If it's high above the breakout level, then it's much higher risk to be betting a full position if it already made its first initial run, and now that first round of people came in and bought, and then the stock rose high above the breakout point. If you're trying to bet late into the game, there's always the potential of this being a false breakout. So buying in high with full positions can be risky, and that's why I'm going to talk about betting with half positions, or only starting out with 5% with trades that you missed the first round to get in because you missed the opportunity to buy right at the breakout point. So if the stock is significantly higher above the breakout point, it may be wise to just open up the position with 5%, and this allows you to buy your second half position or your other 5% to make it a full 10% position on a dip towards a support level, as such as a 13 EMA or the breakout support point or the midpoint of the breakout candle. So this limits the risks of your potential loss, as well as you may have been wrong with betting it on this stock in the first place. So buying a 10% high, all of a sudden this turns into a false breakout. Now you're losing big on a 10% position. Rather, as if you bought in late to the game with only 5%, you will have much less loss if the stock declines from where you bought it. So now we're going to take a look at an example of how to use half positions, the benefits of buying in with only half position to start out if you didn't buy right at the breakout, as compared to buying a full 10%. Okay, so here is an example of buying, later into the game with a full 10% position. So say you missed the actual first buying opportunity to buy here at, around 420, and you missed buying there with a 10%. So you bought later into the session with 10%. You're buying higher in the stock price with 10%, so this puts you at more of a risk if the stock continues to fall from here rather than continues to go up. So if it drops back down to the breakout point at 420, I suggest typically selling if the stock cannot hold above the actual breakout point. That could mean that it's a false breakout, and you may want to exit your position. So if it breaks down 420, the breakout point, you're at about a 6.66% loss on your full 10%, which is still not too bad of a loss. This is just an example I'm making up, And then if it dips, the price has to go back above 450 for you to start profiting on your full position. Price has to go higher as well as your to make profits, as well as you're going to have a higher loss on your full 10%. So now let's look at an example of trading this strategy only using 5% to open your trade, being that you didn't catch the stock right as it was breaking out. So with this example, say you did miss the breakout point by right here. So you bought up here at 450, but you only bought with 5% of your capital. This limits the risk as the stock may continue going up, but it's very common for stocks to make a short-term dip after they break out, giving you a second opportunity to buy near the 13 EMA or the actual breakout point support. So consider you bought 5% up here at 450. This would give you a chance to buy more on a dip if that actually happens. So say the price dipped back down to the breakout support level and you bought a second position at 420. Now your average fill price is 435. So now your average price is 435. If the stock from here continued to break down 420, since your average fill price now on your full 10% is 435 rather than 450, buying at 10% up here, where your loss on a breakdown is 6.66%. Now using this 5% fill strategy, your loss is cut in half on your full 10% at 3.4% loss if it breaks down 420. As well as this, the stock continues to rebound and bounces off a support level. Since your average fill price is 435, now you start making money when the stock breaks out above 435, rather as if you bought full 10% up at 450. You're not going to be profiting until the stock breaks out above the 450 average fill price that you have. So you can see here, using half positions, you're not always going to make the best fill price, and buying higher into a breakout pattern, there's always the potential of the stock dipping after that. So buying a 5% position, for starters, this gives you an opportunity to buy at a lower price if the stock dips to a support level, and this limits your risk, which reduces your loss, as well as if the price dips, you actually get a lower average fill price, so you start profiting at a lower price level. The downside of this is if you didn't buy a full 10% up here and then the stock just absolutely explodes, you're going to make less money. But the goal here is that we're trying to limit risk and limit the amount of money that we're going to lose. We're not trying to maximize completely and just swing for the fences and hope that we make the most. What we're trying to do here is manage our risk, and that's exactly the benefits of using a 5% position if you're buying later into a breakout. If you can catch a stock right as it's breaking out, I always just try to go the full 10% right there. But if I buy later into the session and I miss the actual breakout buy point, then I consider using a smaller position. Maybe I'll do a 2/3 position, so I'm betting 7.5% to open the trade, and I may buy the last 10% of my trade on a dip. But this is just a great example of using half positions if you're buying later into the game and you miss the actual first initial breakout buy point. Okay, so in addition to buying in a stock using half positions, there's also a benefit that you can use, from using half positions, exiting your position as well. I don't always use half positions for exiting. I don't always use half positions for buying. I'm just showing you some of the examples of how you can use half positions to your benefit in certain cases. So say for this example, the same thing, we bought in with our average buy position at 435, came back down, retested the breakout point in 13 EMA, and continued to rise. So you got a big spike in price action all the way up to 520. This would give you about a 20% gain. As one of my rules that I was mentioning before, once the stock gets to about 20% gain, sometimes it might be wise just to lock in half the profits because, you're at 20%. That's what we're shooting for. Maybe I should start thinking about taking half or full profits here. So for this example, say you sold into this strength into 520 for a 20% gain on half your position. But then you wanted to see how much higher the stock could actually go, so you decided that you're just going to ride the 13 EMA trend until it breaks down. So from there, it dipped shortly, bounced off the 13 EMA once again, then rose, got another spike in price action, but we're still just riding the 13 EMA because we want to see how high the stock can go. It stopped at for this example, it stopped at the whole number of $6, which would have been a pretty good profit target, but we didn't sell there. We're still riding the 13 EMA, so the stock eventually broke down the 13 EMA, and we sold our second half position at 575. So the benefit of this is, maybe we didn't lock in or we didn't sell our full position here. So we could have sold our full position at for a 20% gain and just walked away. But instead, we sold half our position, took advantage of the strength, sold for half for 20%, and then we wanted to see how much higher this stock could go and rode the 13 EMA trend. So now our average sell price was 546 as we exited higher on our second half position at 575. So rather than locking in just a 20% gain, we actually had a total average gain of 26% on our whole position. So that's just an example of how to use the 13 EMA as well as how to use half positions for exiting, rather than just taking advantage of this strength here and selling your full position. Maybe you just want to lock in half, and maybe you want to see how much higher the stock can go, just in case it has more legs. And that's exactly in this example. That's what happened. It rose back up again, and eventually broke down the 13 EMA at 575 from where we originally sold our first half at 520. Now we have a total gain of 26%. So here's another example. The same situation. Say the stock didn't continue to rise. So we sold half of our position at 520. We locked in that 20% gain. Then we wanted to trend, follow the stock to see if it could rise any higher. But some cases it might just be peaking out at a certain point. It actually breaks down the 13 EMA shortly after. So for this position, rather than if you didn't take advantage of the strength and you were just holding the stock for the 13 EMA the whole time, you would have sold your whole position at 485. Instead, we locked in half of our position on strength, and then we trend followed the second half using the 13 EMA as a trailing stop, and sold at 485. So our average exit was 502, for a 15.5% gain. Again, I don't use half positions all the time. I'm just showing you some examples of how it can be beneficial to lock in your gains using half positions on strength, and then you never know if the stock is going to be going down from there, or maybe it goes up from there. That's the benefit of using half positions, because you're still speculating. Maybe this stock can go higher and I can squeeze out some more profits, but also you're protecting yourself in the case that the stock doesn't go any higher. You locked in half of your profit at a high point, and then locked in your second half as it broke down the trend, and you still made a better trade than rather than not locking any profits in at all and selling your whole position here. Or, in any case, you could have sold your whole position for 20% and you would have been doing okay. That's exactly why I don't always use half positions for selling. Sometimes I just walk away with my profit and sell the whole thing at a certain price. Okay, so now we're going to talk about, some different management strategies that you can use, based on your comfort level, your skill level, and just, how you feel about trading. So first off, we're going to talk about a passive managed account. This is still max 10% capital into any given stock. Basically, you're typically going to be starting your positions out with 5%. You're going to be very conservative. This is more so for new traders who don't really know what they're doing. They just need to have a little bit of an entry into the market. Maybe they didn't want a paper trade, but they still wanted to, learn how to do it with actually doing it. So this could be a good way for them to do it without putting too much risk and only using 5% of their capital. Sometimes 10% if you can buy a stock exactly, right at the perfect breakout point. Then maybe open your position with 10% rather than just 5. This is also for traders who are, comfortable with buying stocks on dips. As I just went over, trading half positions and buying in 5% high, then buying in 5% low. There's a certain comfort factor being in a mental, ability to buy a stock on a dip. Typically in my head, if I buy a stock high and the stock's falling from there, it's not typically a thought going through my head that, ooh, this is a great entry here to buy on this dip. It's more so a thought in my head of, wait a second, maybe this trade isn't working out. Maybe I should consider exiting. That's not always the case. But if I'm certainly comfortable with the stock that I bought into, then I'll be comfortable with buying on a dip. But this is passive account is basically for somebody who's comfortable with buying on weakness. I'm not always comfortable with buying on weakness. Weakness to me, sometimes is just a sign that the stock is weak and maybe it's not going to rally from here. But as we will be going over many times later, once we go over actual trade examples, you'll see that buying on a dip on the stocks that do ride the trend can be a very beneficial area to buy into. So this is passive account is a lower risk account. This is for newer traders. It's a great way for an entry into the market. Betting smaller positions, starting on just 5%, so that you're limiting your risk and not exposing yourself to a large potential loss in your account. Next up is an aggressive account. You're always going to be buying in with 10%. Just you're going to be very aggressive about your entries and always using 10% for your start positions. Closing out, you can use the full or half position, trend following. Sell into strength half, take the second half and ride the trend to see how high the stock can go. These are recommended for people who are comfortable with entering stocks. They know when to buy, they know why they're buying, and they're not too fond of buying dips. I'm not the biggest fan of buying dips. I just usually many times don't feel comfortable with it because it's kind of opposite of the direction you want the stock to be going. But I don't typically use the full-on aggressive account. I used to at one point. Now I don't. There's this is a potential larger loss on losing trades because you may be buying higher in the breakout with a full 10% position. But if it's a losing trade, then you might have a bigger loss. Whereas if you were using the passive account, bought 5% high and bought 5% low, your average entry would be lower. But this is also has the larger potential gain on winning trades. If you bought in later into a session with a full 10% rather than just a 5%, and then the stock just blows up, you're going to maximize your profit potential from that aspect. So it's kind of a double-edged sword using the aggressive account and then always opening your positions with 10%. You may have you might have bigger winners, but you also might have bigger losers. So that's just a look at the aggressive account. Next up is the hybrid account. Still same thing here is maximum 10% into any given stock. But opening a position, you're basically you're a little bit more experienced now, and you can kind of gauge of what your comfort level is based on where you are buying into this stock. So this is a little bit more of my style of trading. If I'm buying into a stock higher, maybe I felt comfortable with buying 10% high because I felt this was a really great looking breakout. Even though I might be buying high into the breakout pattern, I felt that this stock definitely has an opportunity to be continuing higher. So I bought a full 10% up high, even though I bought higher into the position and didn't feel, and instead of buying 5% high, I bought 10% high because I felt comfortable with doing that, and I am experienced, and I really thought this was a great breakout pattern. So the hybrid account is definitely a very good, open-minded trading strategy where you can gauge your entries and exits just based on how you feel, but you're still using the maximum 10% into any given stock. Up next is the advanced hybrid account. This is actually what I use today. So this is utilizing leverage. Leverage is basically using a margin account. So if you have $10,000 in your account, your broker, if you sign up with a margin account, your broker will probably leverage you 2 to 1. So if you had $10,000 cash, now you basically have $20,000 in buying power on marginable stocks. If you're a beginning trader, this is highly not recommended. Using leverage when you don't know what the hell you're doing, that's the quickest way for you to lose all your money as a trader. After you've been trading for 3 to 5 years plus, and you have actually survived, and you're still trading after those 3 to 5 years, and you figured that you are actually an experienced trader that can consistently make money, you have a strategy that works, and you're a disciplined person, then utilizing leverage can maybe be used to your benefit. But you also have to be frugal with it. You can't just go out and swing for the fences and maximize your buying power. Basically, the strategy that I use is I'm still using a smaller portion of my account, but now I'm using a maximum of 15% cash into any position. So, say if you had a $10,000 account, uh, you would open up a position with a full position would be 15% or $1,500. So basically, looking at it this way, you'd have $1,000 cash in this trade, and then you put $500 on margin. Uh, this is it's a higher risk. Your gains are bigger, but also your losses are potentially bigger as well because you have more money on the line rather than your 10%. So you're actually borrowing pretty much 5% per every trade that you enter. This is it's recommended for consistently profitable and experienced traders. Okay, so now I'm just going to kind of go back over the different accounts and just basically look at what I would recommend for you based on where you are in your trading career. So if you're a brand new trader and you're not into trading and you're just looking to get in, I highly suggest you look over the passive account again. Starting out as a beginning trader, your goal is not to make money. No, hardly anybody makes money in the stock market. As I said, numerous times, only 10% of the people that try out trading ever make it and do it successfully. So, as a new trader, your goal isn't to make money. Your only goal is to survive. If you can survive the game without losing all your money, you're making some accomplishments here. So, once you can learn to survive, then you can learn to start profiting. Is basically what your goal is as a new trader. So, the passive account, it's just a good entry into the market as you're going to be betting with smaller positions and, limiting your risk and, making it harder for you to fail. So I highly suggest that you check out and maybe look into using a passive strategy that I recommended as a new trader. Once you've been trading for 1 to 5 years, I suggest using the aggressive or hybrid account. As I said with the aggressive, it's kind of a double-edged sword. You're going to have bigger wins, but you're also going to have bigger losses. So you need to be able to manage that, with your mental state and your discipline in the market. Your hybrid account, it's more so you're kind of gauging of how big of a position you want to be buying in based on how you feel about the trade. If you're buying in right at the breakout point, do a 10% opening trade. If you bought in later in the session, maybe do a 5 to 7.5% entry, giving you a chance to buy more if the stock dips from there. So, the hybrid is just a little bit more diverse and rounded trading strategy. 3 to 5 years, if you survived the game, you're still trading, and you got a strategy that works, and you're disciplined, and you're consistently making money. Maybe you can use leverage to your benefit. But also, as I said, don't get out of control with leverage. I say here, 2 to 1 ratio. I don't even use that. I use about 1.5 to 1 ratio. So basically, I say max 2 to 1 ratio because basically some brokers that you can sign up with, like day trading brokers and stuff, they might leverage you, times 5 or so. So if you had $10,000, they might be leveraging you up to $50,000. So you could potentially only have $10,000 cash in your portfolio, but if they give you $50,000 buying power and you lose on some big trades with all that money out there, your $10,000 can be gone in a flash. So don't go searching for some broker that's going to just leverage the hell out of you and think that you're going to do this and make a bunch of money. So, be frugal with your leverage. I basically only, I still use 10% cash and basically having an additional 5% on leverage is basically my strategy as an aggressive hybrid leveraged account. Okay, so now we're going to go over the whole process. Basically everything I just went over in a nutshell from chart to finish. I say chart to finish because every trade that I make starts out first by finding the right chart setup and nothing else. So first and foremost comes the technical analysis of the trade, as I'm looking for either a force, survival, revival, or gold pattern. Once you find the right stock chart that you consider to be a possible trade, there's some simple research steps to focus on that can further legitimize the trade and back up the technical analysis aspect of the stock. My research tips for stocks that I trade are extremely simple, as I only look at a few factors about a stock, and it takes just a matter of a few minutes or less before I decide whether or not I want this stock once I find the right chart setup that I like. So step one, the first thing I do once I find a stock chart that I'm interested in trading is head to Yahoo Finance and check out the latest headlines. As we are buying breakout stocks on the move, it is very common and typical of a press release and play that initiated this move either today or recently. It's important to take a look at what the recent PRs are so that you are aware of what the recent hype is about, even if there's even any release or a hype at all. Whether it's a huge contract, insider buys, share buyback programs, or an awesome earnings report, etc. Basically, we just want to know if this is something that can have an impact on the company's future, or at least create some hype and drive price action higher. If there is no recent news, then this may just be a standard technical breakout, and the technical analysts and chartists out there are driving up price action by themselves because of the breakout buy signal. Charts alone can and do work, but when there is some kind of hyped up bullish news in conjunction with the stock chart, then the rally can go much higher and last much longer. If it's just a pure technical breakout, people may look at the stock wondering why has it gone up when there's nothing new going on with the company as of late. So people, may be more compelled to sell into this breakout, which in turn can be a false breakout. So it's always important to look to see if there is news or some kind of new rumor or press release out that's driving hype into this stock. So step two, another thing that is always a helping hand in the confidence factor for your trade is if insiders have recently been loading up on shares of their company. Now this doesn't always mean that a stock will go up at all, but it definitely is not a bad sign to see that the executives within the company are confident enough to buy shares of their own company stock. This typically means that the company is in a position for growth, and the insiders have a confident outlook on the company's future, which in turn can add another aspect of confidence to your trade if the insiders are on your side as well. You can go to a free website called insidercow.com to get all the latest information on your insider buying for any stock that you want. In addition, this also creates hype around a company. So when people see this, this also influences other people to buy into this stock. And when it's in conjunction with the bullish foos pattern, it's definitely good to see insiders buying. So in step three, I would take a very simplistic view of the stock's financials. As we are only planning on holding this stock for a few days to a few weeks, we don't need to waste our time digging through the stock's balance sheets or SEC filings to make sure this is the perfect company. The only thing I really care about looking at is if the company is expected to grow. The most simple way to do this is to head to Yahoo Finance, enter the ticker that you're looking at, and click the Analyst Estimates link in the left column. This will give you the forward-year analyst estimates for earnings and revenues. Upwards growth of 30% or higher is fairly solid for a company. Now, obviously, the higher growth expectations, the more confidence you can have in the trade that you are thinking about entering, and maybe bet a higher amount of your capital. But I'm not saying that a stock needs to have at least 30% growth or higher to make it a viable trade. The stock's financial estimates don't even have to be growing for it to be a good trade. All I'm saying is that when the stock has strong forward growth estimates, this can help legitimize the trade and the reason for you to be buying into this stock. The amount of growth can basically just be gauged as a comfort factor for how confident you are with the fundamental aspect of this trade. Sometimes smaller and less followed companies do not have analyst estimates, so there's no way to use this simple method of looking at a company. If this is the case, you can look at the company's past financial income statements and check to see if the company has been growing in recent quarters. Most stocks which trade on the OTCBB exchange will not have analyst estimates, so this is the method you must take. You can also look at their latest earnings report press release, as this will give you a summary of the company's financials and past year growth. The CEO will also sometimes give you forward-looking growth estimates that you can speculate on. In other cases, small cap companies may have no analyst estimates because the company is in development. This is often the case with zero revenue small biotech companies that are in the process of testing drugs and treatments or diseases, or resource exploration companies such as oil and mineral companies that are in the process in exploration, searching for potential deposits for them to mine and sell. Both of these kind of plays have huge potential to make big trades because of the speculative nature of the company's potential to develop new drugs or find plentiful resource deposits to mine in their exploration process. And again, take note that the company does not always have to be growing for you to enter a trade. I've traded many stocks based solely on technical chart patterns. That's the foundation of my strategy is all with the chart. Uh, you know, the financial aspect is just an extra piece of ammo to add to your trade, which can turn out to be some of your biggest gainers when the technicals and the fundamentals are both in tune together. As in the case of news hype, a company can have horrible growth expectations and crappy past financial results. But if there is a solid news piece that is released, this can spark a big move in a stock that you can easily profit on a short-term scale due to the hype. So it's always important to first check out what the hype is about and the news with the stock if you're interested in the trade before you get all nervous about the financial condition of the company, as good news plus a good chart can definitely equal big profits. Okay, so now moving on to step 4, we're going to talk about the FFV again. So, the next thing you can look at if the company is profitable and expected to grow is the future fair value, or FFV. The FFV will tell you how under or overvalued the company is compared to its industry competitors based on the stock's forward growth estimates and the industry's average price to earnings ratio. This is important because we don't care about what the stock's price is currently. We want to know where we could speculate it going in the future. Let's take a look at the FFV, and another example, which is again calculated by taking the average forward earnings estimates and multiplying it by the average industry PE ratio. So basically, stocks that have FFVs of 100% or more above the current share price, plus a very bullish stock chart, these become very high probability trades. These are the ones that are probably going to have the biggest reactions, both short term and potentially long term, because the fundamentals and the technicals are both in tune. It's basically a very great looking bullish technical setup that's also combined with very strong forward growth prospects. And so that creates a lot of hype around a stock and gives it, a pretty large potential to be going higher moving forward. As I said before, stocks don't need to have a strong FFV value to make a very good trade. It all starts out with a chart setup. If you can have or find other aspects of the trade, such as from a fundamental analysis perspective, to add to the technical bullishness of the chart, then more power to you. That's great. That adds more confidence to the trade and makes it a little bit more of a reliable trade. And as we were looking at that one stock in the first DVD on disc 1, when I first mentioned the future fair value, that was IBCP, and the stock was trading at about $1.60 per share when I was going over it, and it had something was going on. I was mentioning with the chart, we had a lot of volume come in there. It was actually a potential Foos revival pattern, and it had the lowest future fair value I've seen in ever since I've been trading. So I actually, now it's January 18th. I think that was on the 9th when I did that recording. Lo and behold, I just made $10,000 on that stock. So let's go over and see how and why I did that. So as you can see here, IBCP now it's January 18th. It's trading at $4.15 per share. The forward PE the forward PE is now 3.49, so it had dropped, or it's risen from originally at I think it was in the ones when we were first looking at it, and that's because the stock price has risen more than 100% up to $4.15 per share. So now looking at the analyst estimates, they're still 1.19 for the forward year. In the competitors tab, moving forward, the PE ratio is 16.19. So it's still about $20 per share future fair value stock. So it's still very attractive from that perspective. But as I'm not a long-term stock trader, I take advantage of the short-term opportunities. I actually made, on my average entry and my average exit, I made about 71%, I believe. If you want to look here on Profitly, this is a website that verifies all my trades by logging into my trading account. So this is a legit trade right here. This shows you exactly what my profit was on this stock. So looking at IBCP here, uh, my original core position was at about 190 on this trade that I alerted to the Black Service members at the Technical Trader.net, and then I also bought smaller positions up, in the mid to low 2 level. So my average entry ended up being 196. My average exit was 337. I sold some in the low threes, and then I sold some in the high threes. So my percentage gain on the total position was 71%. And this is in a matter of 7 days. And on 7,000 shares, I made 9,812 bucks. So pretty much, $10,000 in 7 days on this stock. So looking here at the stock chart, we can annotate this just to show you, the Foos revival pattern that was in play here. So we got that neckline resistance formed here at this level, and we have the ascending trend line coming in right here. So as you can see, we had that incoming bearish trend for the lead-in trend, and then the stock finally bottomed out here and got that first spike in price plus volume. So that was phase one of the triangle, the three-phase breakout triangle pattern. Then we got the consolidation of phase two, and then this broke out above the neckline resistance on big volume. This is the day that I bought in. Actually, prior to it breaking above 2, I bought in at 190. Alerted everybody at my website in real time that was what I was doing. And I said that my profit target on this stock was about $3 per share, and that's exactly where we went. Within a week later. And then I took some profits in the low threes, and then I sold the rest up in the high threes. And now I'm actually short here. I have a short position on this stock at 417. With a stock that rose this much in such a short amount of time, I'd say it's a higher probability that people are going to start taking some profits, but there still is a lot of strength on this stock. It could keep going forward, and especially given some time after it consolidates, maybe comes back and retests the 13 EMA. I wouldn't be surprised if this turns into another future potential trade that I would want to take advantage of. But for now, as I said, I'm a short-term trader. I took advantage of this short-term huge gain. It was the Foos pattern, the Foos revival pattern, plus a strong future fair value, or a FFV. And this would just turned out to be a huge trade just to kick off January. Made $10,000 on this stock in about 7 days. So that's a perfect example of how to use the FFV and a Foos pattern in conjunction to find stocks that are going to make really big moves in a short amount of time. All right, so now in step 5, we're going to talk about earnings estimates and announcements. So, the thing about analyst estimates is that they are just guesstimates that people throw out there to create hype about the company, thus it can drive price action higher if analysts have high expectations for the company. Who really knows or cares if these numbers are correct or not, because all we care about is that they create hype. Thus, the next thing we want to look at is when the company is releasing its next earnings report. When the company reports the actual numbers, the stock can react very negatively if the company reports below the analyst's expectations. And as I had explained before, it's a fool's game to try and hold and predict a stock through its earnings report. So knowing when a company reports earnings is a very important thing, so you don't get caught in a surprise attack sell-off on a bad earnings report and put yourself at risk of a hefty loss. So you should always go to a website like earningswhisper.com to check up when your stock is going to be releasing earnings next. So just for example, today Apple reported earnings after hours. It says Apple's quarterly earnings crushed the estimates, but the stock actually didn't move that much because it actually gapped down last night fairly hefty because Steve Jobs announced that he was going on medical leave. So the stock actually tumbled today and then rallied back up, and then it reported strong earnings. So it's up after hours 1.26% after it said that they beat the estimates. As I said before, I typically find that stocks, can react more negatively than positively to earnings announcements. But obviously stocks do either go up or go down sometimes in very big percentage moves, depending on how they reported earnings. For example, here's Cree. This stock reported earnings today. See the headline here. It says Cree shares falls as profit outlook misses the estimates. So, they're reported below what the analysts expected them to report. Say if you were holding the stock and you didn't even know earnings were coming out after the close today, it closed at 62 bucks. If you're holding it, all of a sudden it dropped $10 per share after hours, and now it's down 15.61% in after hours trading. So, this is exactly why you would want to go to a website like earningswhisper.com, and check up on when your stocks are going to be reporting earnings, because you don't want to get caught in a surprise attack sell-off like this and after hours trading if the stock reports earnings and they're not up to par with what the analysts were expecting. Okay, so now that we have gone over some simple and fast research steps, we need to get back to the actual chart and technical analysis of the trade. Also take note that while you may find stocks with strong values according to the fundamental research steps that I just went over, if the chart is not in play, then that information is just about meaningless to the trade. There's a saying that goes, when the chart is talking, it pays to listen. So no matter what kind of fundamental research you have done about a stock, or what rumor or news you have read about, if the chart isn't talking, then you have no reason to listen to it. You first need to wait for the chart to start talking, and in essence, form a desirable chart pattern, hence the Foos patterns, and then you can back up that chart with fundamental information, and in turn, hopefully get paid for it. So moving on to step 6, we're going to be talking about the technical tactics. First off, we have to identify our entry point. So as I stated previously, there are several areas where to buy Foos patterns. So when you find a chart pattern that you're interested in trading, you need to figure out if you want to enter now and with how many shares, or wait for a better opportunity. So the best place you can enter a breakout stock is catching the stock right as it's breaking out of its resistance point that signals the actual breakout of the Foos pattern. This is where you can feel comfortable starting out with a sizable or full position rather than starting out light. Because right after a stock breaks out from the resistance point, a wave of buyers usually comes in and can push the stock significantly higher above their breakout point in a very short amount of time, which can put you in a significantly profitable position right off the bat as you were able to catch the first wave of the rally. Although, catching a stock right as it's breaking out of the breakout signal can sometimes be very difficult, as oftentimes you won't even identify a stock as a potential breakout pattern until after it has already happened and you miss the first wave of buying pressure. So depending on how far a stock has run on the day above the breakout, you need to decide how comfortable you are betting with a position. This is where starting out with half or partial positions can come into play, because the stock may be up 10 to 20% above the breakout point, in which case it is very common for the stock to dip from here to a support level before it makes any continuation. But of course, some of the most powerful breakouts will never look back after the first breakout buy signal. So if you find an excellent looking Foos pattern, yet you weren't able to buy the stock right as it was breaking out, it's often beneficial to buy in at least half position or more on the stock, because the strongest breakout plays often don't even dip following the breakout and just keep going up, which can result in some huge short-term gains. So last but not least, after the optimal entry and the later day entry, we'll be looking at dip buying. So if you're looking to buy a stock either for a second position on a dip, or if you were not comfortable with filling a position on the initial breakout, then there are several areas where you can look to buy again on the dip. First spot that will happen on a dip is the midpoint of the breakout candle. The midpoint of the breakout candle has proven to be a very common area where new buyers come in and start buying the stock if it makes a dip following the day of the breakout. The midpoint is the most aggressive dip buying area. Very bullish stocks will typically halt here and then continue upwards in their trend. Yet it is also very common for stocks to dip below the midpoint as well, as anything is possible in the stock market. When a stock drops and closes below the midpoint of a breakout candle, then this is also a short-term bearish candlestick called the bearish cloud cover, which could indicate the further pullback the following day. Uh, next, usually the next area where you should be looking to buy on a dip is if the stock retraces back to where the initial breakout point is. It's very common for stocks to retest the breakout point before they continue their run. There is usually a significant amount of buyers that come back into play at the breakout point because this is once very significant resistance is now very strong support. And last but certainly not least, a very reliable dip buying strategy is to buy on a pullback to the 13 EMA trend indicator. Following the initial breakout, the 13 EMA usually acts as strong short-term trend support and is a common area where new buyers come into play to catch the stock on a dip before it continues in a bullish trend until the stock finally runs out of steam and breaks down the 13 EMA. The next thing you need to do is identify your potential profit targets so that you have a general idea of what areas would be a wise place to start taking profits on your position if these areas are met. Remember that there are basically two areas where we would be looking to lock in gains from a technical perspective, either at the next whole number or the next actual physical resistance area. Note that sometimes there's no physical resistance areas at all. This happens when a stock is at all-time highs and people most typically state the term as nothing but blue skies ahead, because there's nothing in the way of the stock physically, only psychologically. In this case, whole numbers become very solid potential target areas, yet can also easily surpass the whole numbers because there is no physical resistance there. So in these cases, it can also be very profitable to use trending stops, such as the 13 EMA, to see how high the stock can really run when there is no physical resistance to stop it. But trending stops can be used in any occasion. You don't always have to set profit targets, and you can use trending stops for all your trades if you want to see how high these stocks can really go. But I feel it makes it a lot easier to stay disciplined and lock in your profits when you set your profit target areas, act on them, take your money, and move on to the next trade. All right, now moving on to step 8, we have to identify our initial stop level. So first and foremost, remember that when you're buying a stock, you should be looking to have at least a risk-reward ratio of 2 to 1, meaning that you should hope to make double than that of what you're allowed to lose. So your profit target in mind needs to collaborate with your stop levels when making a trading plan. So when you first buy a stock that is setting up in a foos pattern, you'll have to think about how you're going to play defense against this trade if it starts pushing against you. As I previously went over, there are 3 areas of support where I set my initial stops based on how I feel about the trade and how quickly I want to cut my losses. First, there will be the midpoint of the breakout candle, which is the most aggressive stop level. This can be a good stop level in the sense that your losses will be fairly small and you will avoid getting caught in false breakouts fairly quickly. Yet with those small losses, you will also miss out on an abundance of profits because you didn't have the patience to hold the stock through its temporary pullback before it makes a large continuation to new highs of the recent breakout. Second stop, of course, is the actual breakout signal mark. When a stock breaks out above this mark and then fails to sustain prices above this level, it is probable that this is in fact a false breakout and higher prices were rejected by the market and the stock could continue to fall. I almost always sell if and when a stock breaks down below the breakout point, as momentum by this point is not highly in favor of the bulls anymore. The most passive initial stop level is setting it right at 13 EMA. But remember that the 13 EMA is typically below the breakout point when you first buy into a stock. So I usually recommend to wait for the 13 EMA to rise past the breakout point before you start riding it as a trend. Because if the stock breaks down below the actual breakout point, this signals a false breakout of the stock. It could potentially just keep falling down instead of bouncing off the 13 EMA. There's no real strong recommendation for which stop to focus on initially. I use all of these commonly in my trades. It really depends on how confident you feel in the trade, how high you bought in the stock, and what your gut tells you. Yet your confidence and gut feeling is not really something that I can teach you, though. It's something that you pick up after years of studying hundreds of charts and making vast amount of trades in your career. Alright, now moving on to the last and final step 9, we're going to talk about, exiting your position. So there's no right or wrong way to sell your stock. The market is completely unpredictable, so I nor anyone else can tell you the exact right place to sell. It's all relative to how you feel about the current trade that you are in and what you think is the best decision to make based on the indicators laid before you. Typically, what I do when I enter a stock is just ride the 13 EMA following the breakout as a trailing stop and try to sell on any big spikes in price action to lock in the big gains while I have them, and or start taking profits at resistance areas such as physical or psychological hold numbers. Other than that, you can also look for bearish signals prior to the 13 EMA breaking down, such as bearish top candles like shooting stars or bearish engulfing candles, as well as pennant and flag breakdowns, which can potentially get you out of the stock near its highs, rather than selling when it comes to break down a lower support level such as the 13 EMA. The key to success in this strategy is, it's easy to find a stock to buy, but again, the hardest decision to make is when, where, and why to sell it for either a profit or a loss. I'm by no means the perfect trader, and I always make mistakes and sell when I shouldn't have, or held onto a stock when I should have sold. That's just life as a trader. The key to trading my strategy is to identify the right chart patterns, stay disciplined with your stops, and take your profits while you still have them. Because by finding the right chart patterns, such as the disc4 patterns, I'm 100% positive that you will be part of many trades where price rises much, much higher than where you bought into the breakout at. It is up to you from there to have the means and the discipline to capitalize on the opportunity and make money from it.